What is up, everybody? It's Andre Evans, Annex Swallow. We're about to get into a full daily breakdown of the price action over the last couple of days. And this is exactly how you could have capitalized and caught over 3,000 points in trades this week. So let's get into it. Alrighty, this video is raw, won't be many edits because this is going to be truth. Everything that I'm showing you in this video was called live in my Discord, so it is not fake. I have the clips. If you want proof, just ask. But to get firstly into this video, the first thing you need to know is there are 4 stages of price delivery, algorithmic price delivery. And the 2 stages we are going to be covering today are expansion and retracement. Does everybody know what expansion and retracement is? If not, I'm going to show you. Expansion is displacement in a single direction. So that's all expansion is. Don't let anybody confuse you. Don't let anybody tell you it's anything difficult. Expansion is just a displacement in a single direction. Retracement is a retracement or a recoup of some of the expansion back to expand again. So an expansion is a large displacement in a direction. Your retracement is basically your cool off to fill an inefficiency, and this will always turn into another expansion. So every time you have an expansion and a retracement, it should always equal another expansion. And we'll get into firstly how you could have used that here on the higher time frame. So an expansion isn't true unless we reach the 50% of the dealing range. So as you can see here, we'll turn this bad guy on for you. But as you can see here, we had an expansion on Friday. Overnight, Sunday, we retraced back to the 50%. And then what did we get here on Tuesday? Another expansion here. Then we retraced to this 50% here. And then what did we get today? Another expansion lower here, taking out liquidity. And we can expect to still see lower prices because the expansion is not finished. But as you can see there, you could have caught this entire move here and then this entire move again here. Alrighty, but as you can see, that's just a simple framework of using that to catch your daily buys, get your daily, weekly, monthly buys correct. You can't really take trades on the daily chart unless you just have a live account and you're using huge stop losses. But we'll get into the 1-minute chart and I can actually show you how you can use this to execute, and then I'll show you my actual trade that I took today. Alrighty, so by now you should know what an expansion and a retracement is, but there is one more crucial factor that you need to know that is the most important part of this model, and it is where is the draw on liquidity. So if you don't have the draw on liquidity, it does not matter what model you're trading, it does not matter how perfect your setup is. If your draw on liquidity is wrong, the trade is not going to go in your favor more times than not. So to identify your draw on liquidity is very simple. First thing you want to do, go to that 1-hour chart, find out where you are. In this instance, we are here. Here was our market open candle, and where's our 1-hour liquidity? So you see here, we have buy side liquidity there, buy side liquidity here, buy side liquidity here, and buy side liquidity here. So now you have identified your draw on liquidity, and you can just see all we did was go to a 1-hour chart, mark out a swing high, and this is about the high of the day. So now I'm going to tab back over to that 1-minute chart, and now I have my target. So if I already have my targets for the day, now I just need to figure out how to be in alignment with the draw on liquidity. So we'll add a little line here at market open so we can know where the market opened at. Market open here at 9:30. Make that a tad bit smaller. All right, market open here. This is 9:30 market open here. And I'm going to show you exactly how you can use expansion retracement. And if you are correct on the direction, this will guarantee you a 70 to 80% win rate as long as you are correct on the direction. So here in the live stream, I'll put a clip after this. If I am taking along, it's gonna want to be from somewhere around here or somewhere around here. But here we had our first presented fair value gap. Oh. All right, so here we had our first presented fair value gap, and I'm going to make that white for you guys. Here we had our first presented fair value gap. Now, some of you may be asking, what is a first presented fair value gap? A first presented fair value gap is simply the first presented fair value gap after 9:30 equities open. So here we have our 930 candle, and I'm looking for the first fair value gap printed after that 930 candle open. So if this candle here, if 930 open is a fair value gap, this does not count because we use the 929 candle, and that is before New York equities open. So here we have our first presented fair value gap. And some of you may be asking, why is that important? That's not what you told me about. Well, it's important for this very reason here. If you look here, what do we have? We have an expansion higher and then a retracement to, as you can see, the 50%. Why do we look for the 50% when it comes to expansion or retracement? So we can understand where smart money is going to get aligned in price. Look at price like this. If price is expensive, smart money is not looking to buy. If price is cheap, smart money is not looking to sell. So when price is cheap, smart money is looking to buy. And when price is expensive, smart money is looking to sell. And the algorithm knows that. So the algorithm goes back to PD arrays or an inefficiency to rebalance the market, allow smart money to align themselves, and then to reprice towards wherever your drawn liquidity is. So in this instance here, and I'll call this out on live, in this instance here, we expanded higher. An expansion is just a displacement in a single direction, and displacement has to have fair value gaps. If there are no fair value gaps, that is not an expansion. So this is an expansion higher. We have a displacement, and we have higher time frame draws on liquidity up here above us. And we know this because these are 1 hour swing highs. So we got two 1 hour swing highs right here. And then we have a retracement. How is this a retracement? Because we have already expanded towards our drawn liquidity, and then we retrace to the 50%. If you know anything about ICT concepts, you know the market moves from external back to internal, back to external. So what do we have here? This, some people will use as our data high. External liquidity is a swing high. Internal liquidity is an inefficiency. External liquidity again is another swing high. So that's how you could have been in alignment with price today. So here we expanded higher, we retrace. I called out these shorts here. I called out these longs here, and then we longed again to this swing high here. Then if you drag this over here, you can see the exact same thing. But if you're looking at this fair value gap here, is this fair value gap 100% in the discount? No. So what am I going to do? Well, we know that fair value gaps aren't the only PD array created. What do we have here? A bullish order block. Where is this bullish order block? In the discount of this dealing range. And what is this? An expansion. And how do I know that? Because there are bullish fair value gaps in this leg. As you can see, one bullish fair value gap. Here's a little teeny tiny one. It's only about a tick, but that is another bullish fair value gap. And here's another bullish fair value gap. And here is another bullish fair value gap. Now, some of you may be asking, why isn't this my retracement here? A retracement is not real unless the 50% is offered. So in this leg here, was the 50% offered? No. You see here, this bearish candle here, not really much of a bearish candle, but this bearish move here did not retrace to the 50%. So this is not a proper retracement. So if I'm going to keep dragging this until we get a proper retracement. And as you see here, what happens? We tap into this bullish order block, and what do we do from here? We do chop, 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 chop on up here higher, up to this 1 hour swing high, and then we displace lower because all our targets have been met. So that right there is two instances back to back, 100% win rate. Now, of course, you're not going to have 100% win rate, but 100% win rate on the day if you use the expansion and retracement trading model. Alrighty, everybody. So before I get into this next short, I'm going to show you my trade of 8 executions. As you can see, I did take a break even here. I had 100 points, took a break even, didn't trim any. But here is the short I took to catch 200 points. I called it out live. The clip will be in this video. 5-second entry is at 231. And a lot of students kept it, rode it to 500 points, however many points they took off of it. But here you can see the same concept applies on every single time frame. If you look up here in the corner, this is the 5-second chart. And what do we have here? An expansion. How is this an expansion? Because we have a bearish fair value gap. What is this here? A retracement. How is this a retracement? Because the 50% is offered. Now on Trade of 8, I don't have the gone box on here so you can actually see it. But here, the 50% is offered. And what do we get off of that 50%? Another expansion, retracement, expansion. This isn't a retracement because that's not the 50% quite. another expansion lower. This probably is the 50% of this entire dealing range here. 50% was taken, and another expansion lower. And as you can see, this is fractal. It works on every single time frame. We're going to get rid of that and explain how I took these shorts. Alrighty, so if you take a quick glance at the chart right now, what do we see? We see the same exact thing we've been talking about the entire time. What is this? An expansion lower on the 1 minute chart. How do I know this is an expansion, and how do I know it is time to flip my bias? Okay, so you know how it is time to flip your bias when bullish PDRAs start being disrespected on your time frame you are trading, and we are reacting from higher time frame PDRAs as well. So this right here is a 4-hour bearish fair value gap. If I am inside of a 4-hour bearish fair value gap, you never ever want to long inside of that gap. You always want to be doing what the properties of that gap should do until proving otherwise. You never want to long into this gap, especially not down here at the low. As you can see, you would be cooked. So I'm looking at my chart. We've taken out an objective, and we're in a higher time frame higher time frame inefficiency. So now I can look at price, and let me go to my 4-hour chart and let me show you exactly what we'll see. So if I'm looking at price here, and we just talked about price goes from external to internal back to external. So here we went from external back to internal here, as you can see, external again. Where's our next move? Back to internal here. So where's our next move? External again down here. So that is why my bias flipped here in this area. I didn't just randomly guess and pick something and make it up, but my bias flipped here because the market follows these same properties every single day. So now that you know why my bias flipped, we're going to get exactly into how you could have taken this trade. Now the 5-second is a little bit advanced. I don't expect everybody that watches this video to watch this one time and understand how to be able to take a 5-second short. That takes a lot of precision, a lot of practice, and just not something that everybody should be doing. But here on the 1 minute chart, everybody can learn that. So here we have an expansion lower. How did I say we know this is an expansion earlier? Because we have a fair value gap that shows displacement. How do I know that it is valid for me to look for shorts? Because we have a what here? A bullish fair value gap that was inversed, and now the properties are flipped. So now this is an IFVG. Now most of you use IFVGs as a momentum flip, but an IFVG actually should flip properties. So this IFVG here was a bullish PD array. Now once it's been inversed, it is a bearish PD array. So this should support price to deliver lower. So that's why now we've disrespected bullish PD arrays and we are respecting a bearish PD array here. So now I can say, maybe price action is ready to go lower. And what was the final cherry on top? We have a bearish 1 minute gap here. So we have a bearish 1 minute gap right here, which looks like we didn't take out quite yet. Now I was on MNQ actually trading, so maybe this is NQ and we just didn't tap it on NQ. But on MNQ we did tap this bearish fair value gap here to the tick, and I'm almost certain that ES did as well. So here we have a bearish fair value gap, and what should this bearish fair value gap do? It should support price lower. So you could have caught the same exact thing, expansion lower, retrace. 50% has to be offered. It has to. It's non-negotiable. 50% is not offered. If you take an expansion retracement, you are chasing price, and even if you win, you're breaking your rules, and it's not going to work in the long term. 50% is offered here again. First PD array above the 50%, which is this bearish fair value gap, and that is where you want to be looking for an entry from. And as you see here, we displaced lower from there, and that's how you could have caught basically the entire short that I ended up catching today for about maybe 500 or so points. I'm not 100% sure. But a quick little crash course to go over everything. We'll scroll down here. Expansion is a displacement in a single direction. So remember, expansion is a displacement in a single direction. Retracement is the inefficiency being filled or allowing price to be delivered efficiently. So let's say we got a bullish fair value gap here. Let's change the color of this. Change it to black. So let's say we have an inefficiency here. Here you see price fills this inefficiency, and what does this all? This should always equal one thing, as long as you have a draw on liquidity above you or below you, whichever direction you're trading in. But if you get this in a bullish scenario and we have a draw on liquidity above us, and this displacement right here, this expansion has fair value gaps in it, this retracement is not just a bull down, it's not just a straight down like this, straight down. As long as it's a pretty calm and subtle move, you have a retracement. What should that always equal? That will always equal another expansion towards your draw on liquidity. So that's a little crash course, a little video for your notes. Make sure you pay attention, apply this tomorrow, go back test this. This has been playing out every single day for years probably. I haven't traded this for years, but it's been playing out every single day for the months and months and months and almost a full year that I've used this to take plenty and plenty and plenty of payouts. So make sure you go watch this video over and over, save it, playlist it, whatever you need to do, study this video, and I will see you guys in the next.